Hello, my friends, and welcome to Markets Weekly. Today is March 26th, and my name is Joseph. For those of you who don't know me, I teach and write about the markets at fedguy.com. So recently, there's been one issue front and center in the market's mind, and that is what's happening in the banking sector. This all happened 2 weeks ago with the sudden failure of Silicon Valley Bank. That led to a panic among U.S. regional banks that seemed to be stabilizing, but then, seemingly out of the blue, something else happened. Halfway across the world, a major bank, Credit Suisse, failed. Now, to be clear, Credit Suisse was famous for being poorly managed. If you guys remember, Credit Suisse was a major lender to Archegos, who lost a whole bunch of money in mem stocks, and Credit Suisse has lost a whole bunch of money in other stuff as well. They were always a bank that was about to fail, and for one reason or another, they decided to fail last weekend. The Swiss authorities forced UBS to take them over, papered over the entire failure, and everything was fine for market open on Monday. But in the coming days, investors seem to be more skittish around European banks. The stocks of major European banks fell a lot this past week, and their bond prices seem to imply higher probabilities of default. So what happens this coming week and in the following weeks is going to heavily depend, in my view, on how developments in the banking sector proceed. Now, trust me, there is a lot of desperate actions going on behind the scenes. The authorities are willing to do whatever it takes to make this go away. But for us as outsiders, it's not easy to actually know what's happening right now. What I find helpful is to actually look at the Fed's weekly balance sheet disclosures. This is really helpful because the Fed, as we know, is the lender of last resort, not just to US banks, but to dollar banking globally. So monitoring the Fed's weekly balance sheet disclosures helps us understand if the banking panic is getting better or getting worse. So let's pull that up right now and take a look. So this is the most recent Fed's balance sheet as of March 22nd. And you can see that the emergency loans outstanding at the Fed remains still quite elevated. So the primary credit here, that's the discount window, 110 billion. A little bit lower than last week, I believe, but still not good. And the bank defense new emergency bank term funding program, that increased from 11 billion to about 53 billion. So all in all, it seems like banks are still in need of emergency liquidity. Now, this could be out of caution. For example, things are stabilizing for them, but just to be safe rather than sorry, they're still keeping a lot of liquidity on hand. In either case, to be more confident that this panic is passing, we want to see these emergency loan balances decline, and they haven't done so yet. The next thing that I think we should focus on is something that is actually really, really interesting and has not happened before. And that is, for the first time ever, there is a sizable draw on the Fed's FIMA repo facility. The Fed's FIMA repo facility is an emergency lending program to foreign central banks. Now, for those of you who are not familiar with the global financial system, so the US dollar is the currency of the world's reserve currency. And because of that, dollars are used, traded, invested throughout the world. Foreign banks throughout the world take dollar deposits and make dollar loans. Now, in the past, foreign banks, like American banks, like banks anywhere throughout time, sometimes get into trouble. They have emergency need for liquidity. Now, if a bank in the US has emergency need for liquidity, they can go to the Fed as lender of last resort, which is what we see happening for the regional banks. But what if you are a foreign bank in France, for example, and for one reason or another, you suddenly need dollars? You probably don't have access to the Fed's emergency facilities. So what you would have to do is show up in the global financial markets and borrow dollars at all costs. That pushes dollar interest rates higher and frustrates the Fed's ability to control interest rates. So the Fed, since the GFC, has recognized that in order for them to control dollar interest rates and maintain financial stability in the US, they kind of have to act as dollar lender of last resort to foreign banks. Now, they've been doing so through something called the FX swap lines for the past, since the great financial crises. Since 2020, they have this new lending facility where they can act as emergency lender of last resort to foreign central banks who don't have FX swap lines. Now, in general, only countries that are friends with the US have FX swap line relationships, but the dollar banking system is global, and you have a lot of countries in the world, some of them very big, some of them have big dollar banking systems who don't have swap lines. And if they were to fail, it's actually not good for the US as well. So the Fed thought they would also throw them a little bit of a lifeline through something called the FIMA Repo facility, where any central bank can come and borrow dollars from the Fed if they put up treasury securities as collateral. Now, the interesting thing about the FIMA Repo facility is that it's confidential. So if a foreign central bank draws on the Fed's dollar swap lines, that is public. So everyone knows, let's say a Swiss bank or a French bank or European bank is in trouble. But when you draw on the FIMA Repo facility, no one knows who you are. And what we see here is the first sizable draw on the FIMA Repo facility for $60 billion. $60 billion is the maximum amount that any central bank can draw. So this tells us that someone somewhere needs dollars. That's not a sign that the banking crisis is getting better. It's a sign that things are still a bit dicey. Now, the most obvious candidate for this would be the Swiss National Bank. The Swiss National Bank needed some dollars to help paper over the Credit Suisse failure. That makes the most sense. It's the most likely scenario. But just to be a bit more thoughtful, the Swiss National Bank has hundreds of billions of US dollars. They don't really need to borrow any. So this could easily be someone else who is in trouble, who doesn't want other people to know that they're in trouble. Because when people know that you're in trouble, then everyone panics and everything becomes much worse. So this is something that we definitely want to watch going forward. Yes, okay, so this is actually, just wanted to show you some cool charts. This is actually the overall emergency loans made by the Fed. As you can see, it's about the same as last week. It did not get better. And this is the total amount of dollars drawn under the FIMA Repo facility. As you can see, this is the first sizable draw since its inception in 2020. These were just the early ones of $1 billion, were very likely just test draws. If you look at the equity indices for the regional banks here, which I'm showing, you can see that things do tend to be stabilizing. We had a big drop around the failure of Silicon Valley Bank, and so far it's been bouncing around the bottom. So my sense is that things are stabilizing because honestly, the authorities are panicking. So we have Treasury Secretary Yellen and Chair Powell basically willing to guarantee all bank deposits. If you're a depositor and you hear that your deposits are guaranteed, there's a lot less reason for you to panic. And so this should be getting better. In the European banks, though, it's a little bit less clear. As you can see here, the panic that we saw last week seems to be not yet clearly subsiding, and we'll see more about that later on. Now, what's been happening in the banking sector has fundamentally changed how market participants perceive how the Fed will behave. So, heading into last meeting, let's say a few weeks ago, the market was thinking that we were going to stay higher for longer in terms of the short-term interest rates. But what happened last week is that the market now seems to think that the Fed is going to be cutting rates by the end of the year, and pretty aggressively as well. The best way to monitor how the market is thinking about the path of future interest rates is to look at the 2-year yield, which I have here. Now, the 2-year yield is the segment of the Treasury curve that is very sensitive to interest rates. So looking at the 2-year, you can kind of guess what the path of policy the market expects to be for the next 2 years. And as you can see, the 2-year yield was as high as 5% earlier in March, and now after the panic in the banking sector, it's much lower, much lower now at 3.76%. Now, if the banking panic subsides, if it really is just minor, you would expect this to go back towards 5%. But between now and then, there's going to be a lot of volatility and a lot of uncertainty, because from the outside in, it's hard for the investors to know how well the banking panic is subsiding. So watch the Fed's balance sheet to know if it's getting better or getting worse. Broader risk assets seem to be supported by the idea that the Fed will be cutting rates later in the year, markets like low interest rates. If the market were to change its mind and this 2-year yield that I'm showing you again begins to price in more Fed hikes, I would also expect the risk assets like the major equity indices to also be negatively affected. So the next thing that I want to talk about today, and it is something that is pretty, I find, humorous. So as we all know, Silicon Valley Bank bought a whole bunch of treasuries and mortgages unhedged, and then they lost a whole lot of money. They had 120 billion bought. Its market value was only 100 billion as of year-end 2022. So they had $20 billion in unrealized losses. And now this is the Fed's balance sheet. Now the Fed is basically the largest investor in the entire world. They hold $7 trillion in Treasury securities and agency MBS. Last Friday, the Fed published its most recent financial statements, and as of year-end 2022, they had an unrealized loss of $1 trillion, which is it's a sizable amount of money, $1 trillion. Now, I want to emphasize that this really doesn't impact monetary policy at all. The Fed has a money printer. They can never go broke. These losses really don't mean anything to them. But from a bigger financial system point of view, you can think of that the Fed kind of stomached these losses for the private sector. If the Fed did not buy all these Treasury and agency MBS, then when the Fed hiked rates, someone else in the private sector would have had to take these losses. They are sizable losses, $1 trillion. You can easily imagine a situation where an investment fund or some other kind of levered fund, because they took these large losses, either had to puke or had to shut down or so forth. But the Fed, by essentially socializing tremendous amounts of interest rate risk, has helped the private markets weather these interest rate increases a bit more than expected. There's actually interesting analysis by a strategist at Jefferies, I believe, who wrote about this. And the last thing that I want to talk about before closing is that there is some significant geopolitical risk that's not being priced into the market. Now, here is an article saying that Putin wants to place nuclear weapons in Belarus. Now, what's happening, it's really hard to get good information about what's happening between the Ukraine and Russia, but there are reports that indicate that the war effort is not going well for Ukraine, and that the Russians are doing much better. So you can think of what's happening in Eastern Europe as essentially a war between NATO and Russia. After all, NATO was sending a lot of money and a lot of weapons to the Ukrainians, and the Ukrainians are fighting the Russians. I think the assumption always among the Western allies was that because the West is much more sophisticated and much wealthier, as long as they send in the weapons, send in the money, this will eventually be over. But I don't think this is happening right now, and that can make things very unpredictable. If there is heightened geopolitical escalation, Now that has tremendous impacts on both commodities and on currencies. You would expect that there to be significant strengthening of the US dollar as more money moves away from the, away from the war theater and towards safer places like the United States. And you would also expect strong demand for commodities because at the end of the day, for war, you need a lot of commodities. You dig them up, make them into weapons, and blow them up. It's a tremendous cost of resources. So things like steel, which has been doing well, could easily continue to do well in that scenario. These geopolitical things are very difficult to predict. I don't have any insight, but I would emphasize that in war, there's oftentimes a big effort by governments to manage the message. And so if you want to get a good view of what's happening, you really got to have an open mind and listen to a wide range of sources. Just turning on whatever is on a big cable news channel is not going to get you good information. All right. So actually, I think this is a really exciting time for global macro. So I look forward to speaking with you guys again next week. And also, I have a piece talking about the only part of the banking crises that cannot be papered over, which I will talk about tomorrow. All right. Talk to you guys later.